interesting year. It's been a dynamic year for some parts of the sector. You know, there's certain metals, certain companies that have shot through the roof. It's been a year that's required patience for some other parts of the sector. And those, quite a few, I'm sure, of us in the audience here are keen for that patience to be rewarded. So of course the question is, what's going to happen from here? What should we do right now? What should we expect in the short, medium, and long term? So that's what I'm going to try and address in all of 19 minutes. To go forward, you got to start looking back. Of course, the early part of 2016 was phenomenal. I mean, gold gaining 30% in 6 months is like the contrarian dream come true. It then gave most of that back over the subsequent 6 months. But if you look at the chart, 2017 is actually a pretty sustained move, right? I mean, it's 2 steps forward, 1 step back, but we're still moving in the right general direction. So what's next? And I think broadly speaking, I mean, there's a lot of influences on the gold market, but if we want to distill it down, there's 3 primary forces that, in my estimation, drive that, which are rates, the US markets, which are a really important force right now, and then this nebulous thing called uncertainty. So I'll go through each of those, hopefully without too much depth. So, interest rates, the obsession. The market absolutely believes that interest rates will go up in December. In fact, the 2 bars there are most people believing in a 25 basis point hike and a few people believing in a 50 basis point hike. There isn't any bar there for probabilities of no hike. So it's baked in at this point. And because of that, gold is going to have a little trouble as we approach that decision. What I think is really interesting about interest rates, which, as I've said, are the current obsession, is that I think it's a bit backwards. So usually you have a strong market generating strong economic data like inflation and GDP growth, and that prompts stronger equity prices, and in combination that all justifies rate hikes. Right now what we have is rate hikes being used as proof that the economy is strong, which is a bit backwards. So take, for example, when rates move up, the last bunch of times that we have had a rate hike, equity markets have gained on that news, which is backwards, right? Higher cost of capital and increased reason to invest in bonds over stocks should mean that stock markets don't like rate hikes, but instead they've gone up. So what's going on there? Well, what I think is going on there is that investors are using rate hikes as proof that the economy is strong. And they need that because other proof is somewhat lacking. Like, there's no inflation. Obviously, there's lots of debate over how you define inflation, but according to the official measures, there's no inflation. In particular, I point out that there's no wage inflation, which is really important. GDP growth is sort of middling. Tax receipts are declining on both corporate and personal levels. And debt loads are just eating up immense amounts of what would otherwise be productive capital. So we're lacking the proof that the economy is strong. So instead, the market is using rate hikes as proof that the economy is strong. And that is therefore justifying these sky-high equity valuations. But it's a tail wagging the dog situation, right? This is the logic is truly backwards. Okay, so if the logic is backwards, what does that mean for the tightening effort that is underway? The Federal Reserve wants to both rate hikes, that's what I just said, hike rates and shrink the balance sheet. On the shrinking the balance sheet question, that is a complicated issue that we could certainly spend a long time discussing. I posit that quantitative tightening will have a larger negative impact than the Federal Reserve is currently suggesting. The basis of that is that GDP growth is directly correlated to money supply. And quantitative tightening is the Federal Reserve making money disappear. So when bonds expire or when bonds mature, instead of taking that money and putting it back into the bond market, which keeps it alive, they just don't reinvest it and poof, the money's gone. Which makes sense because poof, the money appeared when they were trying to fight the financial crisis. So they're reducing the money supply, and that directly correlates to GDP growth. I think quantitative tightening is going to have a much more negative effect on GDP growth and economic confidence than is currently being accounted. But again, that's another whole conversation. That's the tightening side of things. On the hiking side of things, I think what really matters here is there's this tail wagging the dog situation, but at the end of the day, these hikes are pretty darn small and rates are still really darn low. And members of the Federal Reserve have clearly stated that they pretty much think 2.5% is about as high as they're ever going to go ever again. I mean, never say never, but in the near term, that's about as high as they think things can go because debt loads are just too onerous. You don't want to drown your own government into default by having rates that are too high. So if federal funds rate is not going to go above about 2.5%, and inflation is just going to stay where it is, it still paints the picture for ongoing real rates that are pretty much not there, right? Low, negative, in the ballpark that fundamentally supports gold. So that's the big picture layout, right? The big picture layout is that we have a situation that is supportive for gold in terms of real rates going forward for the next while. In terms of the near-term issue, December, what's going to happen? Well, clearly the market thinks that Janet is going to raise rates. What I want to suggest is whether she does or not, gold is going to go. And I'll get into this again a bit more later on, but the last 2 Decembers, Janet Yellen raised rates and gold went on a run. And that's for 2 reasons. First of all, there's this buy the rumor, sell the news factor that's really important. As we approach this rate hike, people are selling gold in expectation or because a rate hike is bad for gold, but that gets overbaked in. Gold comes off too much, and then as soon as the rate hike decision happens, whether it's a hike or not a hike, the pressure is relieved, and so gold can rebound. And that in December, that leads right into a strong season, which is January, February, reliably a strong season for the market. So if she raises rates as expected, the buy the rumor, sell the news, seasonality argument means that gold should strengthen in January and February. If she doesn't raise rates, it will happen even more so, because that would suggest that things aren't as hunky-dory as the market wants to believe, and uncertainty clearly pushes people towards gold. So December 12th is an important date. I think whether it happens right on December 12th or whether it takes a few weeks to manifest, which is quite common, gold is going to strengthen once we get this issue resolved. Okay, I talked about 3 factors that I think are really important when you're looking at what's going to happen with gold in the near to medium term. The second one is the US markets. Again, a huge issue for discussion. I would argue that they're not really being driven by fundamentals at the moment, and instead they're being driven by sentiment, algorithmic buying, and passive investing. So sentiment, the graph that I have there, that's the greed fear index, that's actually one that I captured a few weeks ago. It has come off now. It's more like in the low 60s, I think. So sentiment has eased off a little. But nevertheless, we're sort of ranging from like 60 to 98, which is an unheard of level of bullishness or greed, depending on how you categorize it. Sentiment is clearly very bullish. Then you have algorithmic buying, which is really ramped up during this bull market. And these algorithms are experientially trained, and that experience, because it's been a bull market, tells them to buy every dip. That really feeds into lifting all the ships as the tide moves, right? The other really important factor is passive investing. It looks like by next year, half of retail equity dollars in America will go into passive investing. Passive investing, by definition, doesn't care about fundamentals. You just buy everything in an index. So it doesn't differentiate between a stock that's, offers specific value based on revenue, price, outlooks, versus just a stock that happens to be in the index. That's another force that is really working to lift everything regardless of value. So I don't think the US markets are being driven by value. Clearly, Valuations are very high based on lots of metrics, but a bull market's a bull market until it isn't a bull market. I'm not going to say that it's about to end tomorrow because I'm likely going to be wrong, but it will end at some point, because they always do. Will tightening be the trigger that does that? Probably not in the very short term, but I would argue that it could certainly play into that over the medium term as tightening manifests a little bit more in the economy. The third factor that I pointed out is uncertainty. A nebulous thing, right? Uncertainty, what is that? Well, it's everywhere is what it is. You can't specifically define it, sort of by definition, because it's uncertainty, but we have a lot of it. We have a lot of economic uncertainty in terms of what tax reform in America will look like, whether it can get passed, whether they can come up with a form that's palpable to Republicans and a few Democrats. We have a real move globally towards protectionism, which is bullish for gold, but is a fundamental shift in how markets have operated relative to the last few decades. This endless obsession over interest rates, this long bull market, there's a lot of economic uncertainty. Then there's, of course, political uncertainty and global uncertainty. So whether you talk about what's going on specifically in Washington or whether you talk about, Spain, Brexit, North Korea, there's Russia, broadly speaking, for lots of different reasons. There's a lot of uncertainty, and uncertainty is a really important factor when it comes to gold. So these things all lay a good foundation for the gold market. I think this slide is probably the same that I used 2 months ago when we were here. And the message is that it's great that gold has fundamentals in its favor, but any mining market is going to be stronger if there's multiple metals participating. And that is clearly the situation that we're in right now. So the two charts that I have here are copper and zinc, which are doing really well. Copper's up, 35% in 12 months. Zinc is up 100% in 18 months. Both look strongly supported. They're both fundamental arguments, especially on the zinc side, where it's just a lack of supply, new supply to meet demand. And these aren't the only ones. Nickel is looking increasingly bullish, as certain stocks would suggest. Lithium went on another run lately. Cobalt's gathering a lot of interest. Uranium had a big move yesterday. Is the uranium question answered? No, there's still too much extra supply, but Cameco's production cut helps. And the fact that there was such a positive response to the news really tells you that people are watching, people are waiting, they're ready, they know that there's an opportunity there. It's just a question of when it starts to go, then people will pile in. So we have a multi-metal setup here, which bodes very well. As this market gets going, I think we're going to have, as I've said, a good January and February for gold. Is that going to be the beginning of the big move? I hope so. I don't know. I can't promise anything. I think it really depends a lot on what happens with the larger US markets, because what we need is generalist investors to start getting a little more nervous about what's going on in the US markets and looking for diversification, looking for something that's that moves differently from the broad markets, and metals are going to be that. But as it gets going, we will get a lot more leverage, and investor allocations to metals will increase. It's cyclical, it happens all the time, and that will increase the leverage that we've really been lacking in the mining equities, as we have still seen zinc prices gain, copper prices gain, gold prices gain, but we haven't gotten the leverage in stocks that you would expect in a strong bull market. That's been a bit lacking, right? I'd say in the last, I think I was looking at this recently, in the last 3 months, when you look at copper gains versus equities, you've only gotten, like, if copper has gone up 30%, stocks have only done, a little bit better than that, which isn't what you want. You want copper stocks to, like, triple the gains that are evident in the metal. It's not quite there yet. We just need more generalist interest. So, getting to the details of today, I'm sure a lot of you are looking at your portfolios, and this is this time of year when everybody starts to focus on selling, which is a terrible idea. I don't want to sound silly, but clearly successful investing involves buying low and selling high. So selling right now at what is reliably the weakest time of the year for metal stocks is a terrible idea. Even if you can claim a tax credit, I'm sure we're all full up with tax loss credits from the bear market. Please and thanks, I don't need any more tax loss credits. And just because I can claim a credit, it's still selling at a loss. It's still the opposite of what you're trying to do. So the message is, if there's stocks in your portfolio that you're sick of looking at, they're not performing the way that you want them to, hold on to them until late January into February, and then make a decision about whether you're going to sell them. Because everything, I think, will be stronger then. So whether you get to a gain or whether you just reduce your loss, it's going to be better to sell in February than it is to sell right now. And the corollary to that is that rather than selling right now, it's the time to be buying. If this is the weakest time of the year, pick up extra of stocks that you quite like, or just look for opportunities that you think are going to do well for 2 months and then sell them in February. There's explorers out there who maybe they averaged, I'm just making up numbers, maybe there's a small explorer out there who averaged 25 cents throughout most of the year. Bunch of those kinds of explorers are available for 10 to 12 cents right now because perhaps the exploration results didn't pan out exactly the way the market wanted to. They're disappointed, winter's setting in, maybe they work in a place where you can't operate in the winter, and the market gets bored and starts leaving. Well, if you can buy a stock for 10 cents that is quite likely to regain its 20 to 25 cent average that was justified all through last year and is probably justified again next year, well, that's a pretty good double in 2 months. I mean, I'm not saying it's gonna happen by February, but it could well do. So this is the time to be buying. This is not the time to be selling, regardless of the fact that everybody around you is going to be talking about tax loss selling, tax loss selling, tax loss selling. Just tune it out. Don't listen to it. That's my statement on that. This one's always in my presentations. How to participate in the markets. This is a pretty savvy audience, so I don't need to go into this in detail, but the few points that I want to point out, it's slightly redundant, about how to invest in the markets. If you're going to buy and sell in the markets, the advantage there is that you can do what you want when you want. Private placements are great for warrants. Warrants, if you believe that we're at the beginning of a longer bull market, are going to be very valuable. So that's clearly important. But the downside of private placements is the 4-month hold period. There's always, if there was a warrant involved in the financing, there's always pressure on the stock starting 2 weeks before the 4-month hold period comes off, because investors who have margin accounts can start selling 2 weeks before the hold period comes off. The price will dip and it'll be at its lowest right around that 4-month hold date. So if you believe in the stock fundamentally, doesn't matter. Just hold it until it recovers or until whenever. But if you're in it for the trade, be careful with private placements because you won't be able to get out at the price that you want when your stock becomes trading again. And I certainly also argue for diverse exposure. I've been trying to do this actively in the Maven portfolio lately. I love exploration. Exploration is exciting, but it's really important to have some diverse exposure. So one of the latest recommendations that I made is a company that owns part of a massive copper gold mine that is going to be developed into the area where they own part of the asset. It's basically a low risk, near-term production story. It's the opposite of what I usually talk about, but it's really important to spread your risk so you're not always on the high stakes gambling end of the spectrum. And of course, across metals. Gold in 2016 was all anybody talked about. Lately, we've seen a lot of interest rotate from gold into copper. Copper is the hot stock right now. So just make sure that you are, and you can't necessarily predict when that's going to happen. I don't think any of us would have said 4 months ago that we expected copper to start moving tomorrow and that it would garner the kind of attention that it has. But we all knew that copper was going to do well at some point, so just make sure that you're positioned broadly enough that you can catch these waves when they happen. It's a complicated market. It's a market that has a lot of forces at play. When stocks jump, there's a lot of things that play into that. So your options are kind of to spend all of your time trying to understand the sector, which is challenging, you know, when you have a life outside of the mining sector. I don't have a life outside of the mining sector, so it's helpful. Clearly, that's a small marketing pitch for myself. I spend my days following the sector, trying to figure out who's doing what and how and where the metals are going to go. I publish a weekly newsletter about what I'm buying, selling, and thinking in the sector. I also have a premium list that, in which I give premium investors the opportunity to participate alongside me when I am investing in private placements. Like all of the other newsletter writers here, just to point out something that's quite important, all the newsletter writers who participate in the Metals Investor Forum are subscriber supported. So we make our money because investors in the same boat as us subscribe to our newsletters. We do not take money from the companies that we cover, so that means that we are not biased by needing to continue covering them because we are beholden. That's what I have to say. I'm sure all of the points that I have made will be taken in much greater depth by other speakers over the next day or two. So I will move on now. Our first speaker of the day